Introduce myself really quick. My name is John Whitaker. I'm Senior Director, Advanced Sales for Crump. I used to be a practicing tax law attorney. I've been with Crump for 10 years now, though, since I left practice. I specialize in helping Crump advisors place large life insurance cases, specifically focus on a lot of estate tax planning. How do we fund these large premium estate policies and trust and navigate the gift tax and those things. Also very comfortable in the world of business planning, etc. So very happy to be here today talking to this group. And yeah, please chime in. As everyone said, happy to have this be as conversational as you guys would like. So without further ado, let me jump into it. Anthony gave a highlight of what we're going to talk about. So yeah, the key, we'll get through some stuff initially, but the key is I brought 4 ideas with me, things that you might be able to implement after we leave today. So let's just jump in it. So I'm going to break this down in talking about the new bill, the new law, which was passed over the July 4th weekend. And I'm going to break it into 2 sections. One, if you remember from the last major tax bill in 2017, there were a lot of expiring provisions, things that were subject to the sunset that were going to expire at the end of this year. So we'll go through some of those and see what happened to them, and then we'll talk about some new things that came in the bill. So the big headline news, of course, especially in the life insurance and estate planning world, is the unified exemption amount. This amount that applies to lifetime gifts, the remainder applies to your estate. And we also have a GST exemption. That's the same amount. This was originally this year in 2025, it's 13.99 million. This is a result of the law in 2017 that doubled the base number from 5 to 10 million. And then that number is indexed for inflation. Under the old rule, it was going to expire at the end of the year and get cut in half. So we were looking at around a 7 to 7.5 million exemption starting next year. The One Big Beautiful Bill Act did 2 things. One, it made the higher number permanent. So there is no longer a sunset provision attached to the exemption amount. It also increased it to 15 million starting next year. So starting next year, we have a new $15 million exemption. It is permanent and it is also indexed for inflation. So seemingly we have a new permanent estate tax regime and we can no longer worry about this, right? Well, I'm going to say the word permanent a lot today. I just want to remind you that nothing that can be changed by Congress is ever permanent. Congress can always tomorrow pass a new law and change this exemption again. So really, it just means it's not subject to a sunset. If you remember, all the way back in 2012, we were also declaring victory, saying we had permanent estate tax reform, our brand new $5 million exemption index for inflation, not subject to a sunset. That permanent regime lasted 5 years. 5 years later, the Tax Cuts and Jobs Act came and changed everything. So, permanent, is one thing when you talk to your clients to remind them. The tax law always changes. We can't stop that. We can't let that stop us from planning. We need to keep plowing forward and just adjust as things change. But the way things stand now, next year, we got 15 million to play with. Another big issue is the state and local tax deduction that people take on their 1040. This is now I'm shifting to the income tax. It was very sort of notoriously, this cap came in 2017 at 10,000. The cap is now temporarily raised to 40,000. It's got a little bit more than that. There's a few extra $100 adjustments over the years. There's a phase out now, though, for folks that make too much money. And the cap, this is temporary. The cap does return to 10,000 in 2030. Qualified business income deduction. This is the 199A benefit. Not a lot of changes here. This one, the main change was it was made permanent. Again, this was subject to the sunset. It no longer is. One headliner maybe is to let you know the amount eligible for deduction is still 20%. There was some talk during the campaign of raising it to 23. That did not happen. So we're still at 20%, but it is now permanent, no longer subject to a sunset provision. Qualified small business stock. This is something that's been around through several administrations. Everyone plays with the rules when they get in office, and so this is where if you start a business, you can sell the stock and exclude potentially up to 100% of the gain from income. There's lots of limits and rules here, and they're constantly tinkering with them. The tinkering happened again. It's a bit expanded. It used to be kind of 100% all or nothing. You had to meet the holding period. Now there's a phase in. You can get a 50% exclusion, 75% or 100%, depending on how long you've held the stock. And the per issue limitation was increased from 10 million to 15 million. Charitable deductions, this is always very complicated because it's extremely diverse depending on what client we're talking about. It's very much specific to the client's situation, what their AGI is, do they itemize or not, what kind of property are they gifting, and to what kind of charity are they gifting it. But we did have some changes, so it's hard to get into details, but generally, taxpayers can only claim these charitable deductions if they itemize and only to the extent they exceed 0.5% of AGI. If you don't itemize, you can claim up to 1,000 for single or 2,000 married filing jointly for cash contributions without itemizing. So you can deduct a small amount even if you don't itemize. The changes are permanent. The old rules had that similar non-itemized amount, but it was only around $600, so that went up a little bit. Lots of other personal tax issues were made permanent that we're not going to get into. If you were going to summarize the Tax Cuts and Job Act and really oversimplify things, you might notice that of all the provisions that were permanent at the time, those were generally the business provisions, the corporate and changes, the new corporate income tax, et cetera. The provisions that affected individuals generally were subject to the sunset. So you found in OBBBA coming back and saying, okay, a lot of these things that were subject to the sunset, we're now going to make permanent on the personal side. So that's the key things people were talking about in terms of what's going to happen under the sunset. Let's talk about some of the new things that are in this law. So some of the new stuff, the first group is related to campaigns promises made by President Trump on the campaign trail. The first one was that income from tips would be excluded from income. That didn't happen. Instead, what folks got was a potential deduction of up to $25,000 of tip income. There are limits to what industries you work in that can take these tips. And this is a temporary provision. And it's also subject to income phase outs. So high income folks can't take this. Not that there's probably a ton of high income folks getting tips. The next one was related to the campaign promise of exempting overtime income from income. That didn't happen either. Similar approach. Instead, a deduction of up to $25,000 joint, 1250 individual for overtime compensation. Again, that's subject to a sunset and it's income phase out. So again, a temporary deduction. The third was campaign promise to make Social Security tax-free. That also did not happen. However, that was addressed or attempted to be addressed at least through another deduction. So, and this is not actually related to Social Security, but every senior is now eligible for a $6,000 deduction. That does also get phased out at certain income limits. What's interesting about this, and I'm definitely not an expert in Social Security planning or the taxation of Social Security. However, my understanding is that Social Security is taxed at different rates depending on your income. So if this deduction reduces your income, not only are you not paying taxes on $6,000 of Social Security income you might be receiving, it might also help you slightly lower the taxes you have to pay on the taxable portion. Then we have a couple things related to cars. There's a new loan interest deduction for your car. This is only on loan interest. So that's $10,000 a year of loan interest. I think that'd be a pretty hefty vehicle I think my loan interest on my car was something like $80 a year. But if you get a higher loan rate and a more expensive vehicle, then this deduction might provide some value. Um, Next, there was repeal of various tax credits that relate to green energy and electric vehicles. So if you have clients that may have been relying on these or are planning to buy an electric vehicle, assuming that these credits will be in place, you want to double check the details and make sure their specific plans are still intact. Finally, this in 2017, we had an excise tax introduced applicable to not-for-profits that paid compensation to certain employees of over $1 million. Generally, and this excise tax is payable by the nonprofit itself. So this was limited to the top 5 income earners in the nonprofit. This was expanded slightly. Now there's not that limitation of the top 5. Anyone who makes over $1 million is now subject to this rule. Anyone, excuse me, working for a nonprofit and making over $1 million is subject to the rule. So it's still a nonprofit rule. It's just been expanded. It's not necessarily the top 5. If you have a nonprofit paying more than 5 people $1 million a year, then this rule you need to pay attention to.
John,
All
really
right.
quick.
Yes,
So if a nonprofit had 10 employees, they making over $1 million, they were only paying the tax on the first 5 employees.
correct.
Okay.
Now it would
And
be all
why do you think that? I mean, obviously, were people taking advantage of it, or why do you think they're expanding that?
when it comes to the whys with tax law, it's usually numbers. This is a revenue raiser and it funds deductions they wanted to take elsewhere.
Yeah.
Usually at the end, there, some effort to minimize the fiscal impact of the bill. So there's a lot of this, and that's why we're getting tip income deduction, overtime deductions. Those are a lot cheaper. It's a lot cheaper to give a $25,000 deduction to folks rather than to exclude all tip income in the country from income. That would be extremely costly. So
Yeah.
it's all about how much it costs.
Thanks.
Yep. Any other questions? Is a great place to stop because next is getting into some of the planning ideas. So I'm happy to talk over any other issues or any other ones that I didn't address.
Were any of these a big surprise? I mean, what's most impactful here?
Well, I'll be honest. So, the gist of this bill, the exemption is the big news. We've been spending 7 or 8 years telling clients, you got to get this stuff done. The sunset's going to kick in at the end of 2025, and your exemption is going to get slashed. So the fact that it's been increased to 15 million and made permanent is really the big headline for us. On the one hand, it's a little bit of a negative for insurance planning. Fewer folks are subject to the estate tax. We might be selling fewer of the smaller survivorship policies, those $5 million SULs that were owned in an islet and funded with crummy gifts. Those sales are going to be less of an option now because if you're worth 20 million and you're married, you're not subject to the tax. However, the good news is at least it is permanent. I talked to so many clients last year who would always say, I just want to wait and see what happens with the election. I just want to wait and see what happens with the election. Well, now the election's over and we have the rules. So there's really no excuse to not get planning now. So that's the good news is people can no longer use the uncertainty as an excuse. The rest of the rules are, and there's, the things I've covered probably compose about 80 pages of an 870-page law. There's all kinds of things in here for corporations, depreciating things, international tax issues. So this is a wide-ranging bill. I've just kind of focused on the things that might affect people dealing, in the financial planning space. So I think the biggest takeaway for us is mainly all of our major, I think, changes happened in 2017. This was mostly making the personal stuff permanent and increasing the exemption. And that's really the main headlines for us.
Okay. Thanks.
All right. So let's talk then, if everyone's ready, about a couple ideas of what, some opportunities that may open under this new regime. And the first is planning with grantor dynasty trusts. So let's take a second, make sure we're on the same page. You'll notice I said grantor dynasty trust, so that might give you some foreshadowing about what the next strategy is about. But for this one, before we get into it, let's talk about what is a dynasty trust, because this is not a legal term. It's a marketing term, and it means different things to different people. There's all kinds of variations, so many different ways you can construct a trust, and probably be accurate in calling it a dynasty trust. So let's just identify some of the common key features that you'll see in most dynasty trusts. So it's safe to say that all dynasty trusts are irrevocable trusts. Generally, they're drafted with special provisions, to create sort of a multi-generational vault. The emphasis is on multiple generations and asset protection. So you're often going to find these in a jurisdiction that allows trusts to stay in force for hundreds or thousands of years or even forever. 20 years ago, that was about 5 states. Today, I think we have about 15. So states have been revising their laws because they are competing for trust business. So we've seen over the last 20 years, some states enact more and more consumer-friendly trust laws. The trust is generally designed so the assets are not included in anybody's estates. They're usually set up by the elderly parents, and they're not in their estates. They're not in the estates of the adult children, and they're not in the estates of the grandchildren or the descendants. So you're setting a vehicle that is outside of the transfer tax system forever. Asset protection is an important feature, and not only from creditors, but from divorcing spouses. These trusts can also be customized with what we might call incentive provisions to guide the beneficiaries and help them lead productive lives. Can often be a big concern for high net worth folks of just dumping cash on their descendants without any guide rails, and actually the money can be a bad thing and can fund bad habits. So you can put controls in here to have the trust make sure that it only makes distributions that reflects the people who set it up, their values. And finally, and this is not standard, so it's something we usually have to request the attorney think about including in the drafting, is that it can own life insurance. If it's a grantor trust, it can own life insurance on the grantor and the beneficiaries. If it's a non-grantor trust, then we're looking at just the beneficiaries. All right, so now that we agree what a dynasty trust is, let's talk about using a grantor dynasty trust and what we're going to do. So this strategy is for folks who are not firmly in the high net worth category. Someone who's very comfortable with the idea of making a big gift this year of their exemption. It doesn't have to be their entire exemption, but generally people who are interested in the strategy are looking to make something relatively substantial. So we're going to show a gift of their exemption, allocate GST exemption to it as well. So that means this trust is funded with no gift taxes and it's 100% exempt from GST. That means for as long as it lasts, all distributions to children, grandchildren, great-grandchildren, great-great-great-grandchildren, no GST will be applied.
I have a question really quick. In terms
Yeah.
of that gift, what does that constitute? Could that be property? Could that be liquid funds? Could it be illiquid? Can it be company stock? What are the factors or the different kind of assets?
It can be anything, really. There's not too much, guardrails on that. Attorneys will have their own preferences on what they like. A general rule of thumb is a lot of folks are looking for, they like to get property that they think is going to quote unquote pop in value. So, the most common example is stock in a startup. You gift it when it's not worth very much, and then when 5 years later you have the IPO and it explodes in value inside the trust. Real estate partnerships make great gifts as well. They tend to grow in value to a large degree. Of course, I work for a life insurance general agency, so this strategy is going to include life insurance. Life insurance premiums have to be paid in cash. So if we're going to include life insurance strategy, we're going to have to figure out where the cash is coming from. So either some of the initial gift will be cash, or maybe we'll gift in income producing property. In fact, let's look at that slide. So they made the gift, and now the trust can buy life insurance policy on the grantor. They can either have made a cash gift of, part of that 13.9 could have been cash, which are going to fund the premiums, or maybe they gifted an asset that produces a cash flow, like a real estate partnership or some business stock or something else, even a portfolio of marketable securities, something kicking off in cash flow that the trust can use to pay the life insurance premiums. So this can be very powerful. A lot of attorneys think by default that all life insurance has to go in a life insurance trust that's by itself with nothing else in it. But the only way to do life insurance trust is to fund an ILIT with crummy gifts, and that's all. Some don't realize that it makes a lot of sense to put the life insurance in the same trust that you're gifting, making these large gifts to, because then you can leverage the cash flow to pay the premiums, and the grantor doesn't have to keep making those contributions. That's especially critical when we're talking about people with very large estates and very large policies where the premiums can be over $100,000 or multiple $100,000. That's going to be far too large to gift using your crummy exemptions for most folks, unless you've got about 100 grandkids. So putting that life insurance in a trust that contains that income producing asset is like putting it in a premium generating trust, and the grantor is relieved of that burden. Benefit of including life insurance, other than just the fact that makes us happy, is it is received income tax free in cash in the trust. So of course, it can be used to help with the grantor's estate tax, but also it can help replenish trust assets. All the gifts that the grantor makes to this trust have a carryover tax basis for income tax purposes. So when the grantor dies, the trust assets do not qualify for the step up in basis. So it's a great idea to make gifts of assets that are going to pop in value, like I said, and that's what the attorney always wants to do. But that also means that they're going to have a whole lot of built-in gain, and when the heirs ultimately start to sell them, they're going to have a lot of big tax bill. So the life insurance can also help pay those taxes on the built-in gain as well. Now, we're going to talk about the difference between grantor trusts and non-grantor trusts. The key thing is, by putting life insurance on the grantor in this trust, that is one of the triggers to cause this trust to be considered a grantor trust. So this would be a grantor trust because we do have the life insurance on the grantor. All right, so idea number 2, probably not shockingly, what can we do with non-grantor trusts? Is there any opportunity there? This might be a bit new to you. In the life insurance world and in general in the financial planning world, I don't think we talk a whole lot about non-grantor trusts. They certainly exist, but I don't know if they're often really, talked about as a planning tool. But there might be some new opportunities here based on some of these changes we talked about in the recent law. So a non-grantor trust, unlike a grantor trust, is its own separate tax-paying entity for income tax purposes. So you can potentially reduce the family's entire total income tax bill by shifting some income into these non-grantor trusts. For example, just by simply putting in the trust in a state with 0 or lower income tax rate might save a little bit of taxes on the state level. Also, when it comes to that SALT deduction we talked about, since a non-grantor trust is its own taxpayer, it has its own cap. So if you're working with someone who's hitting the cap, maybe they can move some property into the non-grantor trust so it can then take its own cap. Real estate portfolios might be a good call here, as they are often subject to state and local taxes. Qualified small business stock, we mentioned how those rules have been expanded a bit. A non-grantor trust gets its own exclusion. So again, it can be a way if you have a client that's has too much holdings, is phased out. Maybe they move some of it into the grantor trust, or even if they're not, maybe they do it just to split, the exclusion from gain. Charitable contributions, non-grantor trusts are treated a little differently than individuals. The rules are a little different. So if the client is struggling to get done what they want to under their own 1040, they might move property to a non-grantor trust and make contributions to charities there. It might be more favorable. Income shifting. When the general rule is when a non-grantor trust has income, it pays taxes on it. However, if it distributes that income out to a beneficiary, the tax liability follows and becomes the beneficiaries. So if the beneficiaries are in lower income tax brackets, then maybe it's an opportunity to do some income shifting. And the last point is you might potentially set up multiple non-grantor trusts to sort of stack these benefits. However, you have to be very careful with this idea that this is limited. There is a statute that does say that if you have multiple non-grantor trusts and they're too much alike, they're all collapsed and treated as a single trust, which would eliminate all the stacking. So that opportunity is there. It's limited. There's some caveats. So that's why clients might be interested in doing non-grantor trusts. As you can see, it's largely for income tax planning. Okay, but where does my life insurance sales idea come in? Well, here's our slide again. This is exactly the same as the first slide. I just copied it. So same function, we're still making a gift. We're still allocating GST exemption. The only difference is that we have a non-grantor dynasty trust instead of a grantor one. So what does that mean? Well, when we put the life insurance in there, we're going to avoid putting it on the grantor. So we don't want to put it on the grantor because we don't want to trigger grantor trust status and undo all that income tax planning. But that's okay. I mean, there's plenty of opportunities to put life insurance on the trust beneficiaries, i.e. the children and grandchildren. There's lots of good reasons for doing this. First, the asset itself is a very strong investment for the trust. While premiums are allocated to the life insurance, that means there's no ongoing growth that generates taxable income every year because life insurance grows tax deferred. Also, when the death benefit comes in, it's received income tax free. So life insurance is one of the few assets you can own in a trust that does not have the built-in gain problem. It doesn't need to worry about it because you receive the entire death benefit income tax free. Also, while this insurance on children and grandchildren aren't going to address the grantor's estate tax issue, it can both replenish the trust assets after each generation. So as the children use up the assets, they pass away, insurance on their lives replenishes the trust. Also, because of that built-in gain issue, we also have the insurance proceeds available to help handle income tax liabilities that might come up from selling off assets with a large built-in gain. Just want to revisit one last time. Here are some maybe kind of like FAQs I get about the differences between a grantor trust and a non-grantor trust. So this is just a couple of selected differences that I'm cherry picking here just to kind of hammer home some of the main differences. So in a grantor trust, so in this example, there's all different kinds of grantor trusts. The revocable living trust that a lot of people set up with a pour over will, that's a grantor trust. So there's all different kinds. This specific kind, since it is an irrevocable trust that's intended to be outside the grantor's estate, this is an intentionally defective grantor trust, or IDGT, if you've seen that acronym and understand what that means. So in a grantor trust, all the trust income flows through to the grantor's Form 1040 and is taxable to the grantor. So when we say the grantor is liable for the trust taxes, that's the mechanics of how it works. The income is literally reported on the grantor's 1040. Conversely, in a non-grantor trust, it files its own form, it's 1041, and it pays its own taxes. So completely different approach. The grantor trust, the IDGT, can be used with some very popular estate freeze techniques. This is sort of the most, intentionally effective grantor trust is probably the most popular estate planning vehicle amongst attorneys over the last 15 years, probably outpacing GRATs at this point. So sale, loan to intentionally effective grantor trust, private loan, private split dollar, all work great.
John, the purpose of that essentially is so the irrevocable trust isn't taxed at the 40% tax rate, but it passes to the grant, whatever the grantor's tax rate is. Is that the kind of primary purpose of that?
I don't know if that's the purpose, but that's the result. So I guess I would say there's sort of as why you might want a grantor trust. I can think of maybe three issues. One, maybe avoiding that 40% top, or it's not 40 more, but of the top trust tax bracket. if the grantor is in a lower bracket, although a lot of these grantors won't be, but potentially. Number two, though, is if the trust, the intentionally defective grantor trust is outside of the estate. So every dollar it spends on income taxes means less is being accumulated for the heirs. Meanwhile, if it's a grantor trust and the grantor has to pay the income taxes, now the whole amount stays in the trust outside of the estate, and we're spending down the taxable estate by paying the income tax liability there. So that's a benefit. And the third one is these estate freeze techniques, the sale loan to an IDGIT, private loans, those can all be done without triggering any capital gain and also without recognizing any income on the loan interest. So these are almost always done with intentionally defective grantor trusts to avoid triggering any income taxes. So that's a disadvantage with the non-grantor trust is it does not work as well with these estate freeze techniques. You could still do loans, but the interest is going to be taxable back to the grantor if they lend. So generally, we're looking that that's sort of the difference in the estate planning flexibility. There's other flexibility involved. The grantor trust is generally more flexible. You can design it as a spousal lifetime access trust or SLAT. So, one point I want to make is we hear all these different terms, and I'm throwing around some of the acronyms too. These are not necessarily separate and distinct trusts. These are features that you can include in any trust. So you could create a trust that's a grantor trust, it's a dynasty trust, it's an ILET, it's an intentionally effective grantor trust, and it's a SLAT. All five things, one trust and that would be an accurate, you could design it so all those things would be true. So a lot of folks kind of think of these things as either ors, but not necessarily. So with the grantor trust, you can make it a SLAT. One of the most popular grantor trust powers is the substitution power. If the trust has a substitution power, that will be a trigger, making it a grantor trust, and that's one of the most common ones used. That allows for great flexibility because what that allows is the grantor can just substitute assets in and out of the trust, and the trustee cannot say no, and the only limitation is that the assets swapped have to be of equal fair market value. So this opens up a lot of opportunities. You can put those assets in the trust that you expect to pop in value. You can let all the growth happen for 20 years. And then as you near the end of your life, you could use a substitution power, swap in high basis assets you have like bonds or something, pull back the trust assets that have a very low basis. Now they're inside your estate for the basis step up. So with a grantor trust, you can play a lot of timing games and have a lot of flexibility. The trust can also make loans to the grantor, which clients like as a fail-safe. It gives them a little comfort since this is all irrevocable planning to know that if things go bad for them, the trust could make them a loan. The non-grantor trust is less flexible. However, there is some flexibility. You can actually make it a SLAT. It's very hard. You have to be a little careful and draft it tricky, but it is possible. Decanting is always an option. That's not quite the fix-all that we sometimes think it is, but sometimes if worse comes to worse, you might be able to decant to a new trust. And that's the idea where you form a new trust and then just pour the assets of the old trust into it like you're decanting wine.
Are those harder to do with NIM-CRUTs?
A NIM-CRUT is a charitable remainder trust, so that's sort of a different issue.
Okay. But those are pretty much you can't decant those. I have a client with one that's
probably not. Generally not. Yeah,
right.
Charitable remainder trusts are subject to their own very complicated set of rules. And yeah, I'd have to look up the rules. I don't know. Generally, though, those are inflexible. So I mentioned the life insurance issues, so I do want to clarify. So I mentioned, in a grantor trust, we're basically free to own life insurance on anyone, including the grantor. In a non-grantor trust, we don't want to include life insurance on the grantor because that is a grantor trust trigger. However, so the actual trigger is if the trust uses income to pay life insurance premiums on the grantor. It makes it a grantor trust. So some folks say, well, then we just won't use premium or income, excuse me. We'll use trust principal to pay the premiums and then we're fine. So that's technically true. Unfortunately, the way the rules work is even if the trust is drafted perfectly and says you're only allowed to use principal, if the trustee makes a mistake and ever uses income to actually pay a premium, the trust becomes a grantor trust. So not only do you have to draft it perfectly, your trustee has to administer it perfectly. And a final issue is that the definition of income is not necessarily the same under the state law trust rules as it is under the federal tax regulations with regard to grantor and non-grantor status. So you might have to track multiple types of income to make sure you're not using federal taxable income to pay your premiums. So it is definitely possible if someone says to you, you can put life insurance on the grantor and non-grantor trust. Yes, it's possible. It's extremely difficult with a lot of traps and a huge risk of going wrong. So we don't recommend it unless they're working with the absolute most sophisticated attorneys and trustees. You need a professional trustee. Otherwise, it's just easier to stick the life insurance on the beneficiaries. Any other questions or comments on dynasty trust, grantor, non-grantor trusts, and incorporating life insurance? All right. Well, our third idea is something that's been around for a while, but we think it's still just as viable and want to make sure you're focused on this potential opportunity. And that's planning for IRAs and other qualified plans. So the challenge with these accounts has always been that if you have an IRA or a qualified plan, it is in your estate and subject to estate tax. However, it's one of the few assets that does not receive a step up in basis. And therefore, your estate pays the estate tax, and yet when your heirs receive the account, they're going to pay income taxes when they pull the funds out. So you have double taxation. So for folks that are worth enough that are still subject to estate taxes, this is a problem. The combined taxes, depending on how big the local is and what brackets we're talking about, can sometimes be 60 to 70%. Another issue, and this isn't due to OBBBA, but under the Secure Act and Secure Act 2.0, obviously they've been making a lot of changes. I'm sure you're all familiar with the new 10-year limitation on inherited IRAs. So for most people, the lifetime stretch has been eliminated. So now we have the same poorly taxed asset, and even worse, we only have a 10-year stretch, not a lifetime stretch. So what can we do? What can we do for our clients that are stuck with this poorly taxed asset? Well, first we can go one slide at a time. There we go. So, well, let's reallocate from the world's worst tax asset into the world's best tax asset, which is life insurance. So we'll take distributions from the IRA. So you can probably tell right away that this is not a strategy that's appropriate for someone in their 40s and 50s. This is a strategy that's appropriate for someone who's at least in their 60s and has already decided, I don't need this IRA for retirement. I'm planning to just let the money sit there. I'm going to leave it to my kids, and I've got other sources of retirement income. So, you don't want to take distributions before age 59 and a half, of course. So these are folks that are either already taking required minimum distributions or approaching those years and are starting to think about it. So we're going to start taking distributions, and we're going to net out the tax. Then we're going to set up our irrevocable life insurance trust and make gifts of those net distributions from the IRA to the trust. The trust is going to take those gifts and use it to buy life insurance on the grantor. Why does this work so well? Well, as I mentioned before, life insurance is income tax free. So it's almost like getting a stepped up basis asset, which the IRA is not. Also, by putting it in the trust, it's outside of the taxable estate. So we've gone from an asset subject to estate taxes, subject to income taxes, to an asset that's not subject to either. And it can also, in addition to being a better value to the heirs, it also now provides liquidity that can be used to help address the grantor's estate tax problems as well. Also, remember I said, these trust terms we use are interchangeable a lot of times. They can apply to multiple trusts. Whereas this screen shows irrevocable trust as receiving, this could be a dynasty trust. There's no reason you couldn't do this and set the trust up as a dynasty trust. So if that, you can combine some of these ideas as well. Yeah, does someone have a question?
Yeah, in this, would you use the annual gift tax exclusion to fund the premium? Like, let's say they have 2 kids. What is the annual? Was it like 15,000 a year? Where were we at with it?
Yeah, it's 19,000 right now.
19.
Yeah.
So would you use that, like, and if
That's
it's
where-
2 parents, I guess you could do 19,000 times 4 for 2 kids, right?
So that's where we start. That's going to make the attorney happy if you can use that. It depends. These are policies on older folks. It depends on the size of the policies. The premiums can get pretty high. So if we don't have enough room using those annual exclusion gifts, or sometimes called crummy gifts, then we have to look at other ideas. One might be using the lifetime exemption, just making the transfer and filing a gift tax return and using some of that exemption. That's going to be 15 million next year. I'll admit, a lot of estate planning attorneys will resist that. There's a bit of a bias against making cash gifts and using the exemption. If they don't like that, then we could look at doing loans. The client might make loans to the trust, and that way the premiums get in there without causing any gift tax.
What's an example? How would that work? The client would like gift 500,000 to the irrevocable trust, and then it would just, that loan is forgiven at time of death, essentially.
Not really. So there's a whole, we have loan regime split dollar and all of the split dollar regulations. So there's all kinds of rules. You would draft a split dollar arrangement. Probably the most common structure in this case would be a payable at death loan. So maybe the trust pays the loan back during life, but most likely it's going to pay it back at death from a portion of the death benefit. There's lots of different ways to structure loans, so the details really depend on the individual client situation. But the general concept is we're just going to make loans of the premiums instead of gifts.
Cool. Thanks, John.
Mm-hmm. Okay. That covers this idea. And by the way, we have a presentation that shows the difference net to heirs if you just leave them the IRA versus leaving the insurance. And it's got a bar graph, and it's very simple and very powerful. Helps clients see the value right away. So we're happy to put that together for you and any of the client opportunities you might have for this one. Okay, let's shift from the world of estate planning more back to income tax planning, and specifically talking about those nonprofits and those execs where we were talking about before with the excise tax on nonprofits paying comp of over $1 million. So as we said, this rule has been slightly expanded, and there aren't, some nonprofits out there that might pay this type of compensation. So what can they do? Or, not even if they're not paying $1 million yet, they want to avoid that if they're even getting close to this number. So you could implement a loan regime split dollar plan. So the idea is the executive is going to own a life insurance policy. The nonprofit will pay the premiums. Now, we don't want those premium payments to be considered compensation, so it's going to be done under a loan regime split dollar arrangement, and those will be considered loans to the executive, which are not compensation. So the policy is funded, and then the premiums are treated as loan, and then there's a collateral assignment put on the policy so that the executive, the nonprofit's made whole, and then there's interest due on the loan that the executive generally pays to the nonprofit every year. There might be some variations where the loan interest is forgiven. If they do forgive the loan interest, that will be included in compensation, so you have to be careful. It depends on the size of the interest. But if they don't pay it or forgive it, then another option might be the loan interest is added to principal and capitalized. But the gist of the idea is we're going to avoid paying compensation and make loans instead. One limiting factor here is when you're talking about loans from nonprofits to executives, they might be considered insiders. They might be prohibited under state law from making these loans. So it is something, it's sort of the way we handle these is we run it by the folks conceptually first. If they like the concept, we have them check with their counsel to make sure they're allowed to make these types of loans under their state's law. We have a list. So we generally have a good idea before we go into it, but we always want to defer to their counsel. Once they get the approval, then we can move forward with the design. After the everything's in place and the premiums have been paid, eventually the executive is going to retire. If they pass away before retirement, then the loan will be repaid from the death benefit. At retirement, the default will be for the executive to repay the loan. They might do it probably by accessing the cash value of the policy. Another option is for the nonprofit to forgive the loan. A couple issues with this, though. If you forgive the loan, that's going to be considered compensation. So if we have a pretty large outstanding loan, we don't want those forgivenesses to trigger that $1 million trap, especially if they're still receiving any type of other compensation. You might forgive the loan over a couple of years to avoid that, if necessary. Another thing is you have to be careful with loan forgiveness that starts to encroach on the 409A, the statute that applies to deferred comp plans. If you make a promise to an employee about a future benefit, you're in deferred comp world. So with the loan forgiveness, what we do is you don't promise it in advance. So if it's something they're thinking about doing, don't put it in writing, don't promise it in advance, have it be a contemporaneous decision at the time. So those are our presentation for today. A few more resources we have. We did put together a piece that goes through some of the stuff I went over today and a few more items on the OBBA and what changes were made. So that's available to anyone who might find it useful. Also, my colleague Karma McCauley, who's another attorney in our team, did a podcast talking about this new law. So if you're interested, you can also check out Karma's podcast. With that,
that podcast is on the website. If you go under resources, and then is it podcast for Insights podcast? It's on our website. So if you need any of that, you can do that. John, that was incredible. The way you have such a passion for grantor trust is really awesome. I've sat through these before, and you always do a fantastic job. So thank you for taking the time to